been there for the last 5 days. I'll show it to you. And it's a nearby floor of support for mortgage-backed securities. So listen, many of you are saying, hey, we got the rate cut. How come mortgage bonds aren't behaving the way that we would have hoped? This happens oftentimes. The stock market is where the money has been going. So a lot of activity flowing into the stock market, new all-time highs. So that's been the game that's been chased right now. This is not unusual by historical standards. We've seen this over and over again. You got the big cut. A lot of it was priced in. We've seen rates come down quite a bit in the interim, right? Remember when they were not too long ago, well above 7%. Today, we got MBA numbers showing 6 1/8 roughly is where rates are trending about. So we've made a lot of progress in a pretty quick period of time. So be patient. Rates are going to continue to come down. Remember, we've told you this many times. It's not in a straight line. A lot of it was a little bit of sell on the news on bonds. But let's remember how this works. Think about this as an investor. So if you're an investor and many of you probably been doing this, you put your money in a money market, you've been getting over 5%. Well, you just got a haircut of 0.5% on that because those money market rates now immediately have come down 0.5%. So maybe instead of getting a little above 5, you're getting a little below 5 now. As the Fed continues to cut, and we know they will, you're going to be getting less and less and less of return. So what do smart investors do? They say, well, eventually that's going to continue to erode my rate of return. So maybe now, while I still can, let me reach for some longer duration and buy longer term maturities, maybe 5 year, 7 year, 10 year. And that's how it kind of trickles the effect into them. Remember, the Fed rate cuts are not going to directly affect mortgage rates. But as you see the Fed continue to cut, and they will, people will search for duration, and some money will go into those longer duration maturities to preserve that yield for a longer period of time. And you'll see that buying on the 10 years, as well as the weakening that we're going to see in the economy. We're going to continue to see inflation be more behaved as the shelter costs come down. So look, the forecast looks really good for us. So don't let this interim blip discourage you. And it hasn't really been that bad. I mean, after all, we're just not seeing an additional move. Yields may be going up a little bit, but not terribly, considering that so much money's gone into the stock market. Okay, I mentioned the MBA. We did get numbers for mortgage applications and essentially saying the refinance boom is here. It was interesting to see on CNBC, the headline story came in and it showed this, mortgage refinance boom takes hold as weekly demand surges 20%. And that's what we saw, refis up 20%. But do you remember on July 22nd, we told you what? Exactly this, prepare for the upcoming refinance boom. It's kind of just crazy how, we kind of felt this was coming. And here we are almost exactly 2 months to the day where it's here, it is hit, and it is, right here, right now that we are seeing this. Now, purchases, this is a big step here. In the title, we said they're not too far behind. Why? Because purchase activity, while it was modestly higher, slightly up, 1% week over week, nothing to write home about. But for the first time in 2 years, the year over year comparison is better on purchases. So now refinance is still making up a lot, 56% of overall applications. So that's a lot, and you should be taking advantage of this. It's just going to get better on purchases as time goes on. Remember, there's a lag there. People got to say, hey, well, rates are now better. Maybe I qualify. Let's start looking. Let's start shopping. Let's start negotiating. It takes time. The media doesn't understand that. But you guys definitely do. And Jake, speaking of home price numbers, Dan's out speaking today. We did get some interesting data on new home sales. And I think that you've done a great job of breaking this down.
Yeah, we did. So this measures signed contracts on new homes for the month of August. And because this is signed contracts, it's a little bit more of a finger on the pulse measure of the real estate market. So I'm going to go ahead and share my screen and we'll break down the numbers together. So once again, this is signed contracts for the month of August, and the annual sales pace came in at 716,000. This was up almost 10% year over year, but the media is really harping on the fact that it was down 4.7% month over month. What they don't mention is this is the third best number this year. And last month, so the number it's coming off of, was the best number this year. So a little bit skewed there. Now, taking a look at the median home price.
By the way, Jake, one other thing, that was a big revision to last month's number. So last month's number got upwardly revised. If you didn't take that into consideration, it's only down 3% instead of 4.7.
You're exactly right there. And taking a look at the median home price, this came in at 421,000, down 2% month over month, down 4.6% year over year. I just want to pause on that thought and come back to it in just a moment. Taking a look at the for sale total inventory, that increased modestly from 459,000 to 467,000. Factoring in our monthly sales pace of 60,000, that gives us a reported month supply of 7.8 months, higher than July's 7.3. But one thing that we have to note with new home sales is the majority of these homes are heir or under construction. So only about 105,000 of them are completed or able to move into, which gives us a real month supply of 1.7 months, still a little bit higher than in July. Now, I did want to come back to that median home price because I know the media likes to harp on the median home price, but this is just a measure of the mix of homes sold. It's not a measure of appreciation. And if we take a look at the months of July and August, where we saw the median home price come down, that's because the mix of home sales was skewed less from the higher end and more into the lower end. So more lower end homes sold rather than higher end homes sold. And so we saw the median home price come down.
Excellent breakdown, Jake.
And tomorrow will be another later update as we get pending home sales, and that doesn't get released until 10 a.m. Eastern. We'll also get a look at GDP tomorrow. And then Friday, we're going to close out with the Fed's favorite measure of inflation, PCE.
Well, thank you, Megan. And also special thanks to Diana, who did just an incredible job of sorting a lot of this data, putting those slides together. So appreciate that. Let's take a quick peek here at where we are. We're down 15 basis points. And I want you to take a look here. We're still within this range. So, we haven't done anything to break out of a range we've been in quite some time, where you see the 25-day moving average has acted as support. And the ceiling that we're seeing here at 101.52, boy, we really made several attempts to get above it, but we're now narrow within this range. So while we're here, there's no reason to be discouraged that we're not getting, the numbers that would show an improvement. Perhaps there's just some consolidation here after the move up, and we have to be just a little bit patient. When we take a look at the 10-year Treasury, it's a similar story. Take a look at this 25-day moving average. I've shown you this before, how it's acted as a pretty darn good ceiling. In fact, we've touched it the last 5 days, and today, similar pattern to 2 days ago and yesterday, where we have breached it, but then by the close, we came down beneath it. So long as that pattern continues, we could be patient and continue to be encouraged that this is just a consolidation. But we also need to be mindful that should we break above in a meaningful way and close above the 25-day moving average, well, that might spell a little bit of a sea change here. And we probably test these highs here in yield, which corresponds pretty close to the 50-day moving average, about 389, 390 range. Could we get there? It's possible. Let's see what happens here today. Without the market moving data that's going to be coming out today or tomorrow, things that would influence the market. We do get, of course, PCE on Friday. But in the meanwhile, if we can't see a close right either on or underneath that, would be a bit of a troublesome sign. So for now, we're going to continue floating.